Hey there, everyone. Happy Thursday, January 23rd. Dave Keller here with Market Misbehavior, and welcome to Chart This with Dave Keller, coming to you from a chilly but quite beautifully sunny Redmond, Washington. I hope you guys are staying warm and doing well wherever you're at. The S&P 500 and other major averages, and really the S&P primarily having a nice, rally to finish the day, pushing the S&P above 6115 into the close. The Nasdaq Composite with that late day surge pushes above yesterday's close. The Dow leading the way higher, though. So we continue to see a risk-on feel to these markets. Today was not as much of a growthy leadership day as we've seen in previous days here over the last week. Growth actually taking a backseat to some value sectors like healthcare and industrials, which finished at the top of the list. A lot of charts to break down, some sentiment numbers with some fairly dramatic shifts from the sentiment readings we saw last week. Investors getting way more optimistic in a very short period of time. We'll see if the market can hold those sustained gains as the S&P and the Nasdaq push onward and ever upward, hopefully beyond all-time highs or previous all-time highs. With that in mind, let's get to our market recap and focus on what happened in the markets today. The Dow really was the story today in terms of the three major averages, led the way through the course of the day. End of the day was a nice push higher to finish at its peak. But the Dow finishing up just slightly below 1%, we'll call it 0.9% to 44,565. The S&P 500 closing higher about 0.5%, 6119, just below that. We'll look at the chart of the S&P. You'll see that bullish follow through that we've been documenting here over the last week or two. Nasdaq Composite, again, with that late day surge, last 20 minutes of trading, pushed narrowly to the upside, about 0.2% higher. Yesterday, we closed just above 20,000 on the Nasdaq Composite. Today, pushing slightly above that. Mid caps flat for the day, actually. Small caps slightly higher. We'll call it 4.4%. So small caps did outperform the Nasdaq, not quite outperforming the S&P 500. You know, that idea of small cap leadership, I guarantee anyone I speak to on my Market Misbehavior podcast, that's definitely going to be a question I ask. You know, what are you surprised small caps haven't led yet? What would you need to see to believe that small caps are a great bet? Do you see that happening in 2025? That's sort of the 1, 2, 3 order of questioning that I kind of pose to everybody. And earlier today, I interviewed Jeff Hirsch of the Stock Traders Almanac. We're getting that episode edited. Hopefully, will be posted out to you later this evening, most likely first thing tomorrow morning. But a great conversation with Jeff about some of the seasonal tendencies, the strength that the market has shown, to be honest with you, even stronger than expected for the beginning of a post-election year. But we talked about the small cap seasonality, which really did not play out as expected. Usually the end of the year going into January is when small caps tend to shine and tend to outperform large caps. Didn't happen. So I'll save the rest of that discussion with Jeff once that episode is released. The other episode earlier this week was with Nishant Pant. And if you don't trade options, that would be a really good episode to watch. He's an options trader and educator. He wrote a book about mean reversion trading using option structures, but he's very technically oriented. As a technical analyst, I will tell you his approach was sound and well articulated. What I love was he was able to connect that directly to here's why a bull call spread or a bear put spread would make sense in this particular example. We walked in detail through one of the trades he's made recently. I encourage you to check that out. I thought it was a really interesting discussion for sure. The VIX, honestly, no real change from yesterday. VIX is sort of treading water in the mid-teens. That's kind of what happens in a low volatility bull market. You know, the VIX, choppy, right? In the fourth quarter, the VIX spiked above 20, spiked actually quite high. A number of times actually pushed above 20 since September of last year. But going into the new year has come back down. And as credit spreads have narrowed, as volatility has lessened, it just tells you we're in a primary bull market until proven otherwise. And there are plenty of charts I can show you that are the charts I would use to track, if and when the bull market, it's probably more when this bull market is taking a major break. I'm not getting those signals today. And widening credit spreads and a spike in volatility would be two of those things I would look for. We're not seeing those at all. Let's look at some of the other asset classes today here on Thursday. Interest rates moving higher, particularly on the longer end of the curve. The 10-year yield finished around 4.64. The long bond yield just below 4.9%. 5-year point is just around 4.4. The short end of the curve essentially remaining stable. So bond prices went down. If you look at the TLT, that's sort of the long end of the Treasury bond curve. The TLT was down about 0.8%, which makes sense given the fact that rates were coming up here. So, the 10-year yield has pulled back after where it felt like it was going to push to 5% and then just keep going. Has pulled back a little bit. Now we're starting to see a bit of a bounce, sort of resuming that uptrend. I wonder if that most recent pullback was sort of a higher low within the context of an uptrend. That would be my general assessment until proven otherwise. Dollar index, no real change from yesterday. I think that's one of the big risks. My conversation with Jeff Hirsch earlier, we certainly touched on the dollar and interest rates and what that means relative to everything else. Strong dollar, I would argue, is one of the big potential headwinds here in 2025. The dollar's been trending higher pretty consistently since last September. No real change today, but that primary trend, I would argue, still very much pushing higher. Looking at the commodity space, you can see the GLD down just slightly, not much, to be honest with you. Silver price is down about 1%. This is definitely sort of a move away from a lot of these commodities and into risk assets like equities. Energy continue to go down. Crude oil, natural gas prices both retreating a bit. The energy sector, not a particularly good day. We've seen crude oil prices come down pretty steadily since Monday. New President Trump, starts talking about a lot additional drilling and focusing more on that sort of thing as opposed to environmental protections generally. And so that is certainly dinging green energy, but also certainly dinging traditional energy as well, implying that the price of crude oil most likely goes down in those scenarios. So continuing to see that trend, and that's really killing the energy trade. Energy stocks had a nice counter trend bounce off of a low toward the end of last year. Certainly seems like that's been thrown cold water on it, I guess, would be the way I would describe it. Choppy, sloppy day for Bitcoin. You can see, leading into today's session, really after we were recording the show yesterday, we've been in a steady decline. Bitcoin did get down to around 101,000 just barely earlier today. Did spike up to just above 106,000. Currently kind of trading right in the middle of that, right around 104,000. It's interesting, again, the primary trend on Bitcoin certainly seems constructive. We've been chopping around this range from around 100,000 and again, slightly below that, up to 107, 108, even 109 over the weekend into this week, but not propelling beyond there just yet. So for now, I would say the chart still looks very constructive. You're not really seeing the follow through right now. Cryptocurrencies generally have tended to move with equities. You think of it like a risk asset. Just with a lot more volatility. But for now, you're sort of seeing equities move higher without cryptocurrencies moving as well. Most of the top 10 coins, as we look today, are in the red. Bitcoin essentially flat from where we were yesterday at this point, and Ether prices slightly higher. All right, looking at the 11 S&P sectors, I think one of the key, if not the key question to focus on as an equity-based investor is leadership. And there are a number of tools to help you sort of make sense of that. I did a show earlier this week on Stock Charts TV that was on Tuesday, focusing on key ratios, looking at growth versus value, small versus large, offense versus defense, some other things as well. You should check that one out if you missed it. Because we talked a lot about sector leadership. And if you think about 2024, sort of in four different buckets in terms of the leadership trends, right? We had a period where it was the Magnificent Seven dominating early in 2024. We then had energy and materials, kind of cyclical sectors leading. Then we had defensive sectors leading kind of July, August. It went back to Magnificent Seven going into the end of last year. Now in the new year, I would say still kind of an open question, right? Days like today, and there have been a lot of these days where it's sectors like healthcare, industrials at the top of the list, things like communication services and technology at the bottom of the leaderboard. So I don't see as much as we're seeing a surge higher in charts like Meta making new highs again, new all-time highs following through. The sector rotation is really not favoring those sectors overall. I mean, it's sort of like one day versus the next. But I think this is a key theme to think about. I would argue that most investors are underprepared and probably underpositioned for value outperforming growth, I don't blame you because growth has done so well for so long, but I am certainly seeing, given the incredible, if not outrageous gains that we experienced in 2024 in sectors like technology, how much so many of these other sectors lagged behind. There could be an opportunity for, a catch-up trade of sorts as you see some of these value sectors start to improve. So for today, healthcare number one, up 1.33%. Industrials number two, up 1%. Third was real estate. The XLRE was up 0.8%. On the bottom of the list, you'll see all 11 S&P sectors were up. So it's a pretty solid day overall. Breadth conditions are pretty good today. You can see technology, communication services, the two bottom sectors, both up slightly from yesterday's close. Consumer staples, number third from the bottom, up about 1/3% from yesterday's close. Looking at breadth conditions just very briefly, I would say, again, advancers outweighing decliners on all of the major U.S. indexes. The S&P 500 kind of right in the middle, about a 2-to-1 ratio of up versus down. We've had some days, and I'm thinking this was yesterday. These were kind of blurs. It's hard for me to remember which day's which, but I'm pretty sure yesterday was one of those where tech and communication services up and kind of everything else was down. That might have been Tuesday, but I remember one of those days very much like that. And you had the opposite, right? You had sort of, most stocks down, even though the benchmarks were slightly higher, most stocks actually were down. Today, you're actually getting all the sectors higher. But again, the breadth actually quite strong. And this kind of move where you see, most, if not all sectors in the green, you see advancers outweighing decliners. This is what a kind of normal bull market phase should look like. Strong price action, stocks making new 52-week highs. We certainly have gotten that today and this week. Breadth more constructive, more stocks up than down. Improving volume. You see the Chaikin money flow pushing back above zero on the S&P 500. I did grab that chart to share with you here in a moment. So I would say you are seeing some of those signs to be optimistic about. All right, looking at the Magnificent Seven and friends, Netflix so far is the juice here of earnings season, according to the FANG stocks. We'll see over the next week. We'll start to get some of the other mega cap growth names starting to report earnings. Netflix is the only one this week still continue to power higher after releasing earnings with some pretty impressive subscriber numbers, raising prices, but investors rewarding that result with a lot of optimism, up another 3.2% today. Meta pushing to new all-time highs yet again, up 2.1%. So, out of the Magnificent Seven, those are your leaders. Those are the ones really getting it done. Today, for example, then you had Amazon, Microsoft, NVIDIA, two of those obviously big technology plays flat for the day. On the downside, Apple, we'll call that still neutral as well. Alphabet down slightly. Tesla down about 0.2%. So Apple and Tesla, again, kind of the outliers for now. We'll see what sort of things happen as we progress through earnings season. We get more details from a number of these companies. But again, Netflix and Meta stand out to me as clear outliers. We'll bring up the market carpet here in a minute. I do want to invite you, of course, wherever you're watching this, if you're watching this on a live stream, drop questions in whatever platform you're on. We're live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you checking it out live, those of you that are doing so. Any comment section of any of those platforms, if you're watching the stream, you can put a question in. I can see all those live here on the streaming platform, and we'll take a question or two before the end of the episode, time permitting. Anything we don't get to, we're planning an all mailbag episode for Friday of this week. Love to answer one of your questions on the show, so please feel free to throw a question in there. All right, let's look to the Magnificent Seven. Sorry, let's look at the market carpet with the Magnificent Seven and the other, 493 odd companies in the S&P 500. By the way, I want to thank you guys. This is one of the things I absolutely love about doing a show and getting real-time feedback from a bunch of people watching this. Someone pointed out, I think it was Palantir, I forget what stock was not represented on the market carpet. And you're absolutely right. It turns out that the market carpet is looking at an outdated list of S&P 500 members. I've talked to the folks at Stock Charts, and hopefully they'll get that fixed soon. But they're aware of the issue, and I appreciate so much the viewer that pointed that out earlier this week. You're absolutely right. Boy, a lot of eyes on a platform like this tend to surface little issues like that. And there are a number of things. Any of the new members in 2024 probably not reflected on just yet. Hopefully that'll be fixed very, very soon, and we'll once again have the correct list. I would still say this is a pretty good representation of what's happening today. And again, most sectors, actually all sectors in the green, some of them a lot more than others, but it strikes me how mixed the market carpet looks today, right? I mean, if you look across here, I would say the average color is kind of neutral, right? Now, part of that is because some of the biggest names were not really moving a ton, right? Look at Microsoft, Nvidia, Apple, Alphabet, Amazon, Berkshire, Broadcom. All of these are within about 0.25% of where we were yesterday. And that same thing can be said for most of the 11 S&P sectors. This was not a big movement kind of day. I would say the surge at the end of the day made this probably look a lot better than it did about half an hour before the U.S. equity market close. But overall, I would say this is more neutral than anything. I would say that one of the observations to make, besides the fact that some of those Magnificent Seven stocks are essentially flat, is again renewed strength in certain pockets of the market within technology. A bit of a counter trend move on some of these beaten down renewable energy names. Solar Edge actually having an up day, which is kind of a rarity recently. Enphase Energy. Now these are stocks bouncing off of very low levels. I am not a fan of buying weakness, what we call the falling knife trade. There's a great falling knife joke that Tyler Wood at the CMT Association told years ago at an event and absolutely killed. At some point on a webcast, I'll dig that one back up and share it with you. But the short answer is I don't buy falling knives. And what that means is buying something at a very depressed price level is usually not a great approach. According to my methodology as a trend follower, buying when a stock is in a primary downtrend or when it is still testing the lows is usually not great because prices go down for a reason. There's a reason why investors have been pushing the price of Enphase down from around 120 to about half of that over the last 3 months, right? That happens for a reason. So I'm much happier being patient and waiting for signs of accumulation. So looking for improvements in volume, look for improvements in momentum, look that show that that investors are willing to buy on the weakness. I'm happy with some early investors getting in at the actual low, and I'm waiting for a low to emerge. So I think Enphase could be a really interesting chart if it confirms a double bottom and starts to rally. I think it's too early to sort of point that out. Another thing I would say, Disney sort of jumps out. I didn't grab that chart, but I mean, some of these, Disney is one of those stocks that actually sold off from a late November peak around Thanksgiving, sold off over the next 6 weeks. And from late November to mid-January, sort of trending downwards. This week, you're starting to see a bit of a counter trend bounce higher. This is a little more of an interesting chart than something like Enphase because we really rallied off of an August low. We were, threatening to regain the early 2024 highs and then pull back again. Maybe this is a new higher low and a resumption of the uptrend. I think a chart like Disney bouncing off of potential support this week could be of interest. I would also note, in sectors like healthcare, industrials, these are the top performing sectors today. Some stocks up big today. GE Aerospace making a new all-time high. That's an earnings name this week. As we, if we didn't highlight it, I certainly meant to. Coming out, UNP, another earnings name. Railroads are always an interesting play. If you think back to Charles Dow's original work, it was the Dow Industrials and the Dow Railroad Index, which were the big, basically the producers of goods and the distributors of goods. Now, railroads no longer the primary distributors of goods in a lot of ways. However, still an interesting way to measure economic strength and optimism about economic growth. And I would say charts like UNP, like CSX, having nice rallies, which have really been sideways for quite some time, could be pretty encouraging. Again, I would say with a lot of those stocks in healthcare and industrials, I don't blame you if you've been avoiding these sectors or struggling to think about why you would be in those sectors, given the strength that we've seen in growth sectors. But a day like today reminds me there are a bunch of other sectors in the U.S. All with some incredibly improving charts, financials as well, come to mind along those lines. All right, let's finish off the show or continue the show, I guess, looking at some charts here. We're going to start with the daily chart of the S&P 500, go through a bunch of other things. I mean, starting off with the daily chart of the S&P, undeniably positive, right? The S&P made a new all-time high today. We've closed above 6,100 for the first time in history today. That's not bearish, right? New highs are bullish. And one of my mentors, Greg Morris, and I consider him a mentor because a great investor and an accomplished technical analyst. He wrote a ton of books on technical indicators. I think his books on breadth indicators were really, really well done. But I would also say he was a mentor because he was a pilot for Delta for like 24 years. He was a Top Gun instructor back in the Vietnam era. And when I was a student pilot in the Boston area, he very kindly shared some words of wisdom when I was struggling with doing stalls and other maneuvers with the airplane. He was just a great voice of reason, talking to me about how to think about flying. And we've often enjoyed joking about the relationships between investing and flying. And one of the things that Greg told me once was all new highs are bullish except the last one. So I will tell you, yes, I'm thrilled that the market's going up. Don't get me wrong. I am always pretty happy when the market is going higher, regardless of what I think should happen or could happen. New highs are good. What I have learned, though, is whatever the primary trend is, you always look for signs that the opposite thing is going to happen. So when the market's in a big downtrend, like we saw in 2022, pretty much the market's going down. So all I'm trying to focus on is what would tell me that we've either established a low or that we're probably establishing a low pretty soon. I have a bear market bottom checklist, and I just keep looking for conditions to fit that mold with which you can describe a lot of previous major market lows. In an environment like this, where we're clearly making new highs, all right, I know the market's going up. So what would tell me that something's different? So you look for lack of confirmation in volume, in breadth, in momentum. You look for the market to go higher on weaker momentum, for the market to go higher on weaker volume, for the market to go higher as breadth conditions are not confirming those highs. That's where I would argue we're still kind of at an open question, right? Here's the S&P closing to new all-time highs at 61 and change, breaking above 6,100 for the first time. The RSI is still below where it was in early December, right? So as we see higher highs from early December to mid-January, we're actually seeing lower peaks in momentum. And I think, again, still to be determined, right? If we rally to 6,500 and the RSI shoots up to 80, it's not a divergence anymore. But I would say at this point, it's too early to say, is this a blow-off breakout, or is this really, building momentum to the upside, because it's still an active trend and it's still an open question. But I think this is something to watch. Breadth indicators like cumulative advanced decline lines have mostly not broken to new highs just yet. So, similar to the RSI, it's not confirming it yet. So, looking to see if those things are confirmed, I think is sort of the game here. But I would say the strength that we've seen over the last 6 or 7 trading days certainly negates the breakdown that we were talking about here, just a week and a half ago, early January. We're talking about a close below 58.50, what that might mean. We're seeing the opposite, right? We're seeing the market resolve to the upside. I'm going to want to follow that as long as I can. And I would say we're certainly seeing that. Now the volume's starting to improve a little bit, and I will tell you, depending on how you measure volume, you're probably either really impressed or not impressed about what's happening this week. If you look at the daily volume readings, this is the SPY that I'm using, and you can do this on the Qs, on mega cap stocks, obviously whatever you want. But one of the basic building blocks of technical analysis, you go back to the classic writings on the practice, is when you see a move higher, is it confirmed by heavier volume? And if you look at the trend in the S&P over the last week and a half, you can actually see that the daily volume is going down, right? Today's volume is actually the lightest it's been since the first trading day of the year. However, the Chaikin money flow is actually looking not just at a daily volume reading, it's actually looking at the volume, but weighting it based on where we close relative to the highs or the lows of the day. So if a big up day has heavier volume, that means a lot. If a slightly up day has heavier volume, that's less important. If a big up day has lighter volume, that's less important. And so it's weighting the strength of the price action versus the daily volume reading. And when you do that sort of analysis, with Mark Chaikin came up with, it's actually pretty good. It's actually improving through the course of this week. So I would say on the surface level, it looks like the volume is going down. And again, looking at daily volume reading, the volume is not increasing at this point. The Chaikin money flow, which is more my preferred way of really understanding volume characteristics over time, the trends in volume, is actually starting to improve here. And the Chaikin money flow was negative from mid-December now to mid-January, just blowing higher this week. Big shifts in sentiment. I'm looking. I'm going to have to pick up the pace here. We're going to be here for a couple hours, and I'll wrap it up here. If you look at sentiment, right, the bullish number up to 43%. We were down in the 20% last week. Last week we were around 25%. A huge shift up to around 43% as the S&P rallied last week into this week. Respondents in this poll, and that poll closes, I think, Wednesday at noon. But the last figure, the AAII, spiking higher in terms of bullishness. The bearishness is right around 40%. It's down to around 29%. So we went from around a 15% gap of bears over bulls to now a 15% gap of bulls over bears. That is a huge swing, one of the biggest swings I've seen in quite some time. The last time we had sort of a bunch more bears than bulls, and it immediately pivoted the last week. Right here, October of 2023, when we were way bearish, the next week we were way bullish, and that was coming off of that bounce off the 150-week moving average for the S&P 500. That was obviously the beginning of some really good trends going into 2024. I don't know if this necessarily means that is happening, but it definitely tells you this was a sudden and meaningful shift from bearishness to bullishness. Now, the concern when you get this many bulls is all of a sudden we hit the euphoria levels where there's too much bullishness. We're not there yet, according to the historical data, but certainly something to pay attention to. The name exposure index, just like the AAII survey, spiked higher quite a bit today. Last week, respondents in the survey of money managers were allocated about 70% to equities. As of this week, they're up to around 86%, which is a big, again, a big shift higher. Suggests that money managers in the survey really rotating back to offense in a very short period of time. So the renewed optimism from individual investors in the AAII survey, the surge in flows into equities as suggested by this sudden shift in the name exposure index certainly explains this big rally that we're seeing in risk assets. Investors once again stepping on the gas. All right, we'll finish off looking at some individual names. I have a couple of these that we featured on the show yesterday. These were earnings named this week. Just wanted to update on what happened because we talked about them with Las Vegas Sands. The question was, do you get enough mojo post earnings to get above the 200-day moving average? The answer for now is no. We're down about 1.25% after what's happened through the course of this week. We're making a new swing low. Again, I think gambling names are a big avoid until you start to see signs of improvement. The RSI back to oversold. This is one of those charts where I probably use a MACD or PPO kind of indicator, particularly on a weekly chart, to find enough of an upside rotation to signal more of a bullish reversal. But for now, not the case. Steel Dynamics, STLD, reported yesterday. Kind of a noisy session today, but at the end did finish slightly lower, about 0.4%. It looked like it was actually going to be trading higher at one point, but finishing back mid-range. So still needs to regain the 200-day moving average. Textron, bouncing off of support around 75, trading up to the 50-day moving average, reporting earnings this week, down about 0.25%. So some of these names where we were saying, all right, if we can see this break, that could be of interest. None of them really breaking out just yet. Textron, again, it could be a very interesting chart. For me, I'm happy waiting for a push above the 50-day moving average. Look for improving momentum. Still not seeing it yet. On the other side, you have names like Capital One Financial. They reported on Tuesday, making a new all-time high today. Today we closed back above the 200-day, or excuse me, closed above $200 a share after yesterday's first close above that big round number threshold. The question when you have a big break above a big round number, do you get follow through today? I would argue we definitely did. COF up another 1.5% today. I think that's a strong trend getting stronger. If only you could have a portfolio of charts breaking to new all-time highs every day. That's a pretty decent portfolio in my opinion. I wrote an article for CNBC Pro earlier today about this stock, Dick's Sporting Goods. We dug into the daily and the weekly chart of DKS, talking about a potential trade setup and what it might look like. I'd encourage you to check it out there if you follow the CNBC. But short answer is it's a break to new all-time highs today, up almost 4% today. As we were writing the article, it's continued to push higher and certainly following through. I think that breakout's an interesting one, particularly after this consolidation. One of my predecessors at Fidelity, Bill Doan, made a career out of looking for what he called big base breakout stocks that had a big sideways congestion range and then finally broke out. I think were he alive today, he would be very excited about a chart like DKS this week. Visa also making new highs. And when I talk about bearish momentum divergences, I think Visa is a great example of what to look for, right? We see the rally in November and December on weaker momentum. When you have that bearish momentum divergence, the question is, do we resolve that finally to the upside by making a new high on stronger momentum? And that's what we saw. We're no longer making new highs on weaker momentum. We're back to making new highs on stronger momentum. I would say that gap last week, and then the upside follow through that we've seen this week tells me Visa is back to being a pretty strong leadership name. UMP, I mentioned an earnings name today, gapping higher about 5%. Again, railroads have not been particularly great stocks. They've underperformed because they've been generally sideways. I'd still like to see a chart like this get above 250, get above 255, clear those 2024 highs. But for now, certainly rallying. And I would say if we fail here, definitely sort of a ripe environment for swing trading, right? A congestion zone doesn't mean you can't make money, right? You buy the lower end of the range, you sell the upper end of the range, wait for a big breakout of the range to signal a change to that configuration. And again, I'm thinking of straddles and strangles and other techniques based on my conversation with Nishant Pant earlier this week on the podcast. We talked about some option strategies. And again, there are great option structures that allow you to bet on blowouts in either direction, bet on low volatility. Charts like this remind you why that can be a very profitable way to address a stock that's not really directionally moving. Semiconductors starting to show a resolution to the upside. We talked about, I think, monolithic power systems earlier this week. Here's the SMH finally breaking above what I would see as resistance around 260. That's where we hit in October. We tested that again in November. We tested it again with this bearish reversal in early January. This week, we're breaking above 260. I think holding that is a pretty strong setup. Problem is you have overhead resistance around 280, so that would be the next level I would be looking for. Remember the bearish engulfing patterns that were very clearly defined on the chart of the SMH in June and July. I would love to see if we could get above there. For now, I think breaking above 260 in the short term is encouraging on stronger momentum with the RSI pushing above 60. Meta making a new all-time closing high today, closing around 636. That's up another 2.1%. Meta continues to be, probably the leader, probably along with Netflix, the leaders in the Mag 7 sort of group of leadership names. Would love to see the momentum continue to improve from here. Did not mean to click there. Sorry about that. RSI is for now just above 60. You want to see a breakout on stronger momentum. I don't have volume on here, but the Chaikin money flow continuing to surge higher would be encouraging as well. But overall, I think completing that break above $600 and resolving to the upside, it's a pretty good setup. I think that's a high percentage setup to the upside. You know, UPS is one of those charts. I love to quote Paul Tudor Jones, nothing good happens below the 200-day moving average. The only thing that scares me from a chart like this is the fact that I can count 1, 2, 3, 4, 5, 6 times in the last year that it's failed to get above the 200-day moving average, with a pattern looking a lot like what we've seen in the last week. So I'm going to go ahead and be patient and wait for UPS to finally show that it can regain the 200-day and hold it. But it's worth noting this is starting to look like a big double bottoming pattern and breaking to the upside. All right. That is it for now. Let me take some questions. I've seen some questions come in as we've been going on. Boy, I'm not going to have time to get to all of these, but the things I don't have, don't get to, we will put in the mailbag for sure. Let's see. Charles, watching on YouTube. Thanks so much for watching. Charles, you said, I'd like to buy a position of about 6% per stock, but what sizing for ETFs? Yeah, and again, I love to quote Price Healy. I think I quoted him recently. He's Big Trends is the name of Price's outfit, I believe. I'm sorry, Price, I don't remember that off the top of my head, but really nice guy based in the Midwest and a capable technical analyst and options trader. He would say if your position size is, if you're having trouble sleeping at night, your position size is too big. And I think that's a great general way of thinking about it. I don't know what the right answer is in terms of an allocation to individual trades. I've heard some people say 2% of your portfolio is about right. I've heard some people saying going to as high as 10% is good because they want a more concentrated portfolio. I think in terms of the right percentage, it really is up to you and your risk appetite and how comfortable you are having concentrated bets, how comfortable you are having exposure on particular names. If 6% is right for you, then that's the right answer. And again, I think that's something you learn a little bit with trial and error. I've had periods where I had very concentrated portfolios, and it was difficult because I struggled with the risk of exposing to certain individual names and having the upside potential, but also the downside potential. So my general answer to your question is, I think that's a question you have to answer. But I would say, in terms of stocks versus ETFs, I don't think I would think of them very differently. But there are two things that I would keep in mind. Maybe three things. Number one, if we're talking about equity ETFs, I would probably think of them as very comparable, because that's the whole idea of an ETF, is it's sort of in a stock-like wrapper. So it trades like a stock. You have a lot of liquidity like you do with a stock. So I wouldn't think of it that differently. If you're talking about other things like commodity ETFs or currency ETFs, maybe a little different, right? Because it's more of an asset allocation bet. So I have a big position in gold a lot of times, and that's bigger maybe than 6% of a portfolio, but that's an intentional bet to have a big percentage in commodities. And so I guess that's something that I would think in mind, is whether that's an allocation, we're allocating to a different asset class, or whether you're just thinking of general risk management. I would also say you can't really generalize with ETFs, because some ETFs are relatively illiquid. They have higher fees. They have wider spreads. So I would be scaling a position with those assumptions, right? So if you have a similar allocation, but it's an ETF with not a lot of liquidity, meaning when you want to buy, there's not a lot of volume. And if you want to sell, there's not a lot of buyers necessarily. Maybe I'd probably lighten up my allocation just because it's less. There's less liquidity. There's more risk embedded in just the slippage of buying and selling. Those are some of the considerations I would think about. But generally, generalizing stocks versus stock ETFs, I would think of them in a very similar way, assuming you do the due diligence and so forth. Let's see. 3P, let's see. Oh, sorry, you're referring to someone else's. Oh, yeah, updating on the Hindenburg-Omen print. Yes, and yeah, you said, let's see, caution, not correction, is what I got at Dave's answer. Yeah, so yeah, the Hindenburg-Omen again is more of a long-term signal, and I think I mentioned this on yesterday's show. With the Hindenburg-Omen, that signal from December is valid. There's nothing I would see that would invalidate that signal, but it's just whether it's going to be proven right or not. The problem with the Hindenburg-Omen, it's not a great timing tool, right? When you see the Hindenburg-Omen flash, that doesn't necessarily imply today is the day that you sell. For me, it's a huge red flag. And then I start to look for conditions on the daily chart of the S&P to tell me, okay, that big bearish rotation that seems clear from the Hindenburg-Omen, it could take months to complete that rotation, because tops are not a moment in time, they're a process. So I would say the action we're seeing this week certainly tells me this is not the week when the Hindenburg-Omen is proven correct by any means. We're certainly seeing strength over weakness. As you would say in most sports, there's a lot of game left, though. And so I would say that major topping signal that we talked about last December certainly could be proven right. It does have me thinking there's probably limited upside beyond what we've seen, and I don't see the S&P just ripping to the upside and having another 2024. I can't imagine that that's a likely scenario. It's possible, but I would not say particularly likely. Last question, Dave, do you have a Discord? I'd love to learn more. 90% of these other people on YouTube aren't very reputable. I appreciate you implying that I am reputable compared to those, and I appreciate you asking about that. So a couple comments. Listen, I'm not a big fan of talking negatively about other traders and other educators and other practitioners that I see out there. I'd prefer to let what I do speak for itself, and I appreciate if you think what I'm doing is reputable. It's certainly what I've tried to do over my career, and that's certainly my goal of taking what I've learned working with big money managers and sharing it with individual investors and helping them make better decisions. That's my goal. So I appreciate that. I do not have a Discord, and the main reason is because I am not a fan of having my eyes glued to my screen, looking at chats pop up and down. I'm much more of a mindful, take my time, let's get back to each other when it's helpful for both of us. So I do have a member community. It's at marketmisbehavior.com. You can click on become a member in the upper right. Use the code. What should you use? YouTube is probably a good code to use for a special deal on your first 12 months on any plan. If you do sign up for it, you're welcome to do so. And there's a members only community. It's sort of an old message board format, but it's a great way to share charts, and it's a really active community. And I'd certainly love you to check it out if you like. And as a quick public service announcement, as I bring up the disclaimer, I've had a number of people asking me whether I'm part of a WhatsApp group talking about cryptocurrencies and something called like the whale strategy or something. I got to tell you, I don't use WhatsApp, and I don't have assistants that use WhatsApp. I'm not a fan of that, of using that at all. I do use WhatsApp to keep in touch with people I know outside the US, where WhatsApp is a primary communication tool. But if you get some ding about a WhatsApp group featuring me and my work, it's not true, and it's not me. And I hope you're not sucked into what seems like a very compelling argument they seem to be making. All the stuff that I do is on my website, marketmisbehavior.com. So before you sign up for anything, I would go there and make sure that it's something that is part of my my official book of work. That's it for now. Thanks so much for joining me here today, folks. Thanks for all of the great questions. I didn't get to some of those. I'll put them in the mailbag. All mailbag episode tomorrow. Don't forget to check out my podcast. We're releasing an interview with Jeff Hirsch. Great discussion about seasonality. He's the editor of the Stock Traders Almanac. Don't miss that one and the other episodes on my YouTube channel. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.